Modern Financial. This is the only place that forges stronger portfolios by putting market hype through a brutal stress test. I'm your lead analyst. Today, we're taking a sledgehammer to the numbers at Electronic Arts. Now, the headlines, they're painting a masterpiece, a gaming Goliath at the absolute peak of its power. But you know our job here is to look past the glossy press releases and inspect the rebar, check the foundation, and see if this company is really built to last. So the big question is this: is Electronic Arts a financial fortress, or is it just a house of cards waiting for a gust of wind? Let's get to work. Okay, let's get the lay of the land. EA just dropped their Q3 FY26 report, and I gotta tell you, the headline numbers are absolutely monstrous. I mean, on the surface, this looks like a complete blowout quarter. It's the kind of report that screams market dominance, the kind of thing that makes investors sleep very, very well at night. But, you know, that feeling of security? That's where the danger is. It's like looking at a brand new skyscraper, all glass and steel, gleaming in the sun. You just assume the foundation is solid rock, but what if it's not? What if the real story isn't the view from the penthouse, but the stress fractures forming in the basement? That's what we have to figure out today. Are we looking at a fortress, or is it all just a pretty facade? Exactly. And to figure that out, we have to start where all the strength begins, the top line, the money coming in the door. And believe me, their latest quarter, Q3 of FY26, was an absolute monster. The company is pulling in revenue at a pace that is just staggering. And that right there is the first and most important pillar of any financial fortress. You have to respect the sheer horsepower in their portfolio that lets them rake in this kind of cash. Yeah, just look at that number. Let it sink in. Over $3 billion in net bookings for a single quarter. And this isn't just some nice, steady growth. This is a 38% year-over-year explosion. A number like this doesn't just whisper, it screams market dominance. It tells you that whatever their game plan is, they are executing it to near perfection. This is the first massive pillar of the bull case. And look, you don't have to take my word for it. Just listen to the company brass themselves. Strength of our portfolio, landmark launch exceeded our expectations, continued momentum. You hear that? That is the language of pure confidence. They are pointing right at their crown jewels, Battlefield, EA Sports FC, Apex Legends, and they're telling the market these pillars are not just strong, they're stronger than ever. This right here is the bull case in a nutshell. Their biggest, most important franchises are firing on all cylinders and delivering in a huge way. Whoa, hold on a second. A fortress can have the thickest walls in the world, it can have the tallest towers, but none of that means a thing if the treasury inside is empty. Revenue is great, it's impressive, but profit? That's what pays the bills. And while everyone was getting hypnotized by that shiny $3 billion number, they completely missed a deeply, deeply concerning figure buried in the exact same report, a number that suggests there isn't just a crack in the foundation, there's a chasm. And here it is. This is the problem. Look at this chart. The street, the so-called experts on Wall Street, they expected almost $1.50 in earnings per share. What did EA actually deliver? 35 cents. Let's be clear, that is not a miss. That is a catastrophic failure of profitability. So the question becomes, how on earth can a company brag about record-breaking sales, more money coming in than ever before, and then fall so spectacularly short on the bottom line? It's like throwing the biggest party ever, selling every ticket, and then realizing you somehow lost money. Something in the business model is broken. Okay, that's a fair challenge. It's a huge miss, and we are going to dig into the profitability problem. But let's not lose sight of where that cash is coming from in the first place. An EPS miss of that magnitude often comes from a massive, front-loaded marketing blitz for a blockbuster launch, which is exactly what happened here. So you can't just dismiss the revenue side of the equation. That revenue flows directly from the raw power of their intellectual property. These franchises are the load-bearing pillars of the entire structure, and from where I'm sitting, they look incredibly secure. And this is what I mean by strength. Let's break it down. In that same record-breaking quarter, Battlefield 6 wasn't just a hit. It was the #1 best-selling shooter of the entire year. That's total market domination. At the same time, their live service engines, the games that are supposed to print money year-round, are still growing. Apex Legends net bookings are up double digits. EA Sports FC is up high single digits. These are not tired, aging franchises on their last legs. They are active, expanding ecosystems generating billions of dollars. That is undeniable operational power. See, I'm not denying a big launch can move the needle. Of course it can. But a real fortress isn't built on splashy one-time events. It's built on steady, reliable, year-in, year-out income. And that's where this whole story starts to get a lot more complicated. Let's just rewind the clock a little bit, go back a couple quarters to Q1. Yeah, sure, full game sales looked great, up 27% thanks to a new release. But now, look at the real engine of this company, live services. This is their bread and butter. We're talking over $1 billion in a single quarter, and it was down 1% year over year. That segment, the one that's supposed to be the high-margin, recurring revenue bedrock of the whole company, was showing signs of weakness, and it was dragged down specifically by Apex Legends. So, while Q3 looked fantastic for Apex, if you look at the data from earlier in the fiscal year, you see this underlying volatility. That 1% dip in Q1, it wasn't just a blip. It wasn't a rounding error. It was a warning shot across the bow. It proved that even their most critical load-bearing revenue pillars can start to wobble, and it shows that this picture of universal, nonstop, unstoppable growth just doesn't hold up when you really start kicking the tires. And then you get to Q2. Net bookings dropped a staggering 13% year over year. Now, I know what you're going to say. Context is critical, right? They were going up against the launch of College Football 25 from the year before, which was this once-in-a-generation release that shattered every record. A tough comparison is an understatement. Any company's numbers would look soft against that. But a tough comp is still a weak result. A 13% drop is a 13% drop. It shows that there's real volatility in their earnings power. It proves their performance is dangerously dependent on these massive tentpole releases. And when they don't have one, the underlying business can look pretty shaky. A true fortress is supposed to be able to withstand a quiet quarter. This suggests EA can't. All right, let's go deeper then. Let's move past the top-line revenue and look at the financial bedrock of the company. The question is, how is management handling the capital? Because a confident management team, one that truly believes in the long-term strength of their own structure, they invest in it. They return capital to shareholders. It is signal to the market that they believe their stock is fundamentally undervalued. And on that front, EA is sending a very, very powerful message. Just look at this number, $2.5 billion. That is how much cold, hard cash EA spent buying back its own stock in the 12 months leading up to the end of Q2. This is a massive vote of confidence coming directly from the inside. Management is essentially screaming from the rooftops, we believe the single best investment we can make with our money is in ourselves. It is an aggressive, shareholder-friendly strategy, and it demonstrates a powerful belief in the company's future value. Or it's a desperate attempt to prop up the stock price while the actual business is getting weaker. Because where do you think that $2.5 billion comes from? It doesn't just appear out of thin air. Let's run a quick stress test on their balance sheet, shall we? In a single quarter, just 3 months, from the end of March to the end of June 2025, their cash on hand plummeted by over $600 million. That is a massive cash burn. So while you see a confident buyback program, I see a company that's draining its emergency reserves. The real question is, are they spending too much, too fast, just to keep Wall Street happy? This isn't reckless spending. It is a stated, disciplined corporate policy. They've made a formal commitment to the market. They will return at least 80% of their free cash flow directly to shareholders. This is part of a long-term financial framework. It's not some panicked reaction to a bad quarter. It's a deliberate, multi-year strategy designed to create shareholder value. But is it a disciplined policy to give away the majority of your cash when you're missing your earnings estimates by a country mile? I mean, does that sound wise to you? If your profitability is under severe pressure, as we saw with that huge EPS miss, maybe the truly disciplined move is to conserve cash, to shore up the foundation, not spend it all on buybacks. It feels like they're slapping a new coat of paint on the walls while the pipes are bursting in the basement. All right then, let's look forward. A company's true strength, its long-term durability, lies in its blueprint for the future. Is management just coasting on past successes, or do they have a credible, ambitious plan for real growth? Well, EA laid out their entire vision at their recent Investor Day, and I can tell you it's anything but complacent. They're drafting a blueprint for total and complete entertainment dominance. The key takeaway here is the sheer scale of the ambition. They aren't talking about small, incremental gains. They are promising to outpace the entire market. They are promising to double their audience to over 1 billion, with a B, billion people. They're planning to more than double the size of a single franchise, The Sims, in just 5 years, and even expand that IP into a feature film with Amazon. And on top of all that, they explicitly promise to expand their operating margins. This isn't just a plan. It's a powerful, forward-looking blueprint for massive growth. And this is coming straight from the top. The CEO, Andrew Wilson, he's talking about the growing scale and scope of their IP. He's not just talking about making video games anymore. He's talking about shaping the future of entertainment. This is the vision of a true market leader, a company that believes it isn't just participating in the industry, but is actively building its future. It is an incredibly compelling narrative of strength, vision, and strategic foresight. It is a very compelling narrative, a grand blueprint, a confident CEO, a bold vision for the future of entertainment. Which brings me to the one single massive question that completely undermines everything you just said. It's the one piece of evidence that calls their entire independent strategy into question. If the blueprint is so strong, if the future is so bright, why in the world are they selling the entire building? Here's the bottom line. On September 29th, 2025, Electronic Arts signed a definitive agreement to be acquired, to be sold, for $55 billion. So all that talk about a long-term vision through fiscal 27, all that talk about shaping the future of entertainment, it becomes almost irrelevant. You have to ask yourself, why would a company with such a powerful, independent growth story agree to sell itself? It raises profound questions about management's true confidence in their own blueprint. Because actions, as they say, speak louder than Investor Day presentations. And this action screams that they believe the best path forward is in someone else's hands. That is the elephant in the room. And you're right, that pending acquisition changes the entire investment thesis. So we have to bring it all together. We have to synthesize everything we've looked at: the powerful revenue, the weak profits, the aggressive capital returns, the heavy cash burn, and now the sale of the entire company. It's time to weigh all the evidence and come to a final verdict for everyone watching. Is this stock an opportunity, or is it a trap? Okay, let's lay it all out on the table, side by side. The bull case, the argument for the fortress, is built on the undeniable raw power of their intellectual property. You've got record-breaking net bookings in Q3, dominant franchises that are still growing, and an aggressive commitment to returning cash to shareholders. It is a case built on pure operational strength and clear market leadership. But the bear case, the argument for the facade, is built on everything you don't see on the surface. A shocking miss on profitability, clear signs of weakness and volatility in their most important segment, live services, a balance sheet that is burning through cash at an alarming rate, and, most importantly, a management team that, for all their bold promises about the future, has ultimately decided to cash out and sell the company. That single fact casts a very, very long shadow over the entire bull case. Which brings us right back to our core question. We've examined the blueprints, we've stress-tested the pillars, we've checked the foundation for cracks. So after putting this company through the iron financial ringer, is the structure of Electronic Arts sound enough to build a piece of your portfolio on? Or are the risks hidden inside just too great? So here is our final verdict. Electronic Arts is a company with a solid steel frame. That frame is its world-class, irreplaceable intellectual property. Battlefield, EA Sports, The Sims, Apex Legends. That IP is incredibly valuable, it generates enormous amounts of revenue, and it is the core of all their strength. It is not going anywhere. But a frame isn't a building. The concrete being poured around that frame, the profitability, the cash flow, the execution, is showing serious, undeniable cracks. And the fact that the original architects are selling the project to a new developer before it's even finished, well, that tells you everything you need to know about their confidence in finishing the job themselves. So our final take is this: the assets are grade A, but the execution is a B- at best. The pending acquisition is a massive wild card. You're not investing in a finished fortress, you're buying a construction site with a very questionable contractor. Invest accordingly. That's all for this edition of Iron Financial. We'll see you next time.